Hey everyone, and welcome to this explainer. Today, we're unpacking exactly how the infrastructure giant Ferrovial managed to generate massive, market-beating growth amidst a really complex macroeconomic environment. Now, if you follow this sector, you already know the headwinds out there are very real right now. We're talking about stubborn global inflation driving up operating costs, deeply unpredictable traffic patterns ever since the pandemic, and broad economic uncertainty that makes long-term planning incredibly tough. But looking at Ferrovial's first half of 2026, they're telling a completely different story. It is a masterclass in pricing power and highly strategic capital recycling that completely bucked the wider trends. Let's get right into it. First off, you really have to look at the sheer scale of their operations. I mean, 4.7 billion euros in first half 2026 revenue alone. But honestly, that top line is really just the beginning of the story. The fascinating part is how efficiently they converted all that revenue into pure profitability. They drove a staggering 21.6% jump in like-for-like adjusted EBIT. And just as a quick refresher, when we say like-for-like, we're basically stripping out all the noise, things like currency fluctuations or one-off asset sales, so we can look strictly at their core apples-to-apples operational growth. So we're going to look under the hood today to see exactly how they engineered this massive margin expansion. So where did all that growth actually come from? Well, we're going to break it down into four quick parts: the financial highlights from the first half of 2026, their highway profit engine, the construction division's record backlog, and finally, their future strategy and sustainability efforts. Okay, kicking things off with Section 1, the H1 2026 financial highlights and the big picture. The crucial takeaway right off the bat is the incredible contrast in their growth metrics. While their reported revenue growth was a very solid 5.2%, their apples-to-apples like-for-like growth was actually double digits, with adjusted EBITDA reaching a super healthy 746 million euros. And a massive piece of this puzzle is heavily anchored by their U.S. assets. U.S. highways alone delivered 521 million euros of that adjusted EBITDA. What this tells us is that beneath the headline numbers, their core operational assets are just performing exceptionally well, and they're completely insulated from some of the wider sluggishness we're seeing over in the European market. Which brings us right to Section 2, the highway profit engine and their pricing power in action. Because let's be real, that massive U.S. profit doesn't happen by accident. You see, behind these huge financial figures are sprawling, complex physical assets. We're talking about massive stretches of concrete and steel winding their way through major metropolitan areas. But make no mistake, financially speaking, these aren't just your everyday roads. They are highly calibrated profit engines. This is where the true financial momentum is being generated every single day, primarily through something called dynamic pricing. To really wrap your head around how this pricing power works, take a look at the 407 ETR up in Canada. Overall traffic, which they measure in vehicle kilometers traveled, barely nudged up. It grew by a very modest 1.8%. Yet their earnings absolutely skyrocketed by 24.4%, pushing past 950 million Canadian dollars. It's a textbook demonstration of the pricing power they unlocked with their toll rate increases back in January. The takeaway here? They don't need massive traffic spikes to generate massive leaps in profit. That is the fundamental magic of dynamic pricing. It's the ability to adjust tolls based on real-time demand, which keeps the road uncongested for drivers willing to pay while simultaneously maximizing the revenue they make per vehicle. And wow, the story's even stronger down in the United States. Across the Texas-managed lanes, their revenue per transaction massively outpaced the 2.7% U.S. inflation rate. Just listen to these jumps. NTE grew by 18.9%, NTE 35W by 17.3%, and LBJ by 11.7%. Even over on the I-77, where they don't even have a price cap in place, they still saw an 11.8% jump. People always talk about infrastructure being the ultimate inflation hedge, right? Well, this data is the definitive proof of that. Because these assets provide an essential service, getting people to work faster and letting them bypass awful gridlock, commuters are going to keep paying the tolls even as broader consumer prices rise. It's a built-in mechanism that feeds directly to the bottom line, completely regardless of what the broader economy is doing. If we just isolate that NTE asset in Texas for a second, you can literally see this unstoppable climb, jumping from $65 million in Q2 2024 to an incredible $82 million in Q2 2026. But honestly, what's even more impressive than the absolute revenue is the margin. NTE is currently operating at a staggering 85.7% adjusted EBITDA margin. Let that sink in for a second. 85.7%. That level of profitability is almost unheard of in heavy infrastructure. Normally, you only see margins pushing 85% in high-tech software or SaaS companies that have virtually zero marginal costs. To achieve that on a physical highway is just a massive testament to the sheer efficiency of their operating model. And we're seeing the exact same growth pattern over on the LBJ managed lanes too, which propelled up to $63 million this past quarter. What's absolutely fascinating here is the why behind the numbers, because this growth isn't just about charging people more. It's being driven by a highly favorable traffic mix, meaning a lot more heavy commercial vehicles, coupled with some new technology enhancements they rolled out in 2025 that drastically improve vehicle classification. By using tech to accurately identify and charge these massive commercial trucks their fair share compared to standard passenger cars, they're capturing revenue that might have just slipped through the cracks before. In this case, better technology quite literally equals better revenue capture. Moving on to Section 3, Construction's Record Backlog. This is really the solid foundation of the company. Because remember, Ferrovial isn't just managing existing roads, they have a massive foundation in building them too. Their construction arm just delivered a record-breaking order book of over 18 billion euros. That is an all-time high. And get this, it doesn't even include roughly 2.6 billion in pre-awarded contracts they have waiting in the wings. Now, it's important to note they aren't just buying up revenue to inflate this number. They're actively maintaining a solid 3.5% adjusted EBIT margin, which perfectly aligns with their long-term targets. Now, to a layperson, 3.5% probably sounds tiny compared to those 85% highway margins we just geeked out over. But in the notoriously risky, wildly complex, and traditionally low-margin construction sector, a steady 3.5% is actually a massive sign of highly disciplined, healthy management. It means they're bidding smart, not just bidding aggressive. And that provides incredible visibility and stability for the entire group's cash flow for years to come. Finally, let's wrap up with Section 4, Strategy and Sustainability, and look at how they are future-proofing the business. So, with a huge war chest of cash from those highways and this massive construction backlog, what are they doing? They are actively recycling capital by selling off non-core or mature assets. For instance, they sold their 22.5% stake in the UK's Silvertown Tunnel, locking in an €8 million capital gain. They also divested from TransChile, generating another €22 million in gains. Then, they take that freed-up cash and deploy it directly into higher growth opportunities, like bidding for the new I-24 Southeast choice lanes in Tennessee and the I-285 East in Georgia. These choice lanes represent the absolute next generation of dynamic pricing infrastructure in booming U.S. Sunbelt states, and they offer significantly higher long-term growth potential than the mature assets they just sold. It's a continuous, highly strategic cycle of value creation. And on top of the financials, they continue to lead the pack in sustainability. This is evidenced by their top-tier ESG ratings across the board, including scoring that coveted CDP A-list status for environmental leadership. And this isn't just corporate speak, it translates to real-world, highly tangible impacts. A prime example is their milestone at Turkey's Dalaman Airport. This is truly incredible. They made it the very first airport in the entire world capable of meeting 100% of its electricity demand exclusively with solar panels. Achieving complete solar self-sufficiency at a massive international transit hub is a huge leap forward for the whole industry, and they actually pulled it off. So, as our urban congestion gets worse and environmental demands only continue to grow, I want to leave you with this thought. How will the combination of dynamic pricing and green infrastructure fundamentally reshape the cities of tomorrow? Ferrovial's numbers prove that the future of infrastructure is highly adaptable, financially robust, and increasingly sustainable. Think about that as you navigate your own commute this week. Thanks so much for joining us for this explainer, and keep learning.